Meantime, back home, turning to a recent trend on the street, companies turning to spin-offs to boost returns. Our Seema Mody joins us at Post 9 to talk about some numbers. Hey, Seema.
Carl, following years, right, of mergers and acquisitions, we're seeing companies primarily in the industrials and healthcare space increasingly looking to spin-offs, and many have been successful. Take a look at J&J's Kenvue, which spun off earlier this month, up more than its parent company and the S&P 500. And then there's GE Healthcare, which has been a standout, up about 40% since going public, outperforming again GE and the benchmark. In fact, analysis from Morgan Stanley shows that spin-offs outperform the market on average by 10.2% 2 years after a listing, while the parent companies see their stock prices drop on average by 8.1%. And we continue to see new deals. So far this year, 73 global carve-outs compared to the 78 we were at this time last year. That data, according to S&P Capital IQ, Goldman Sachs' global head of M&A, David Dubner, telling us we should expect more deals as tighter credit conditions reduced interest from private equity.
The slowdown in the IPO market, coupled with a slowdown in more broadly the private equity landscape, has led to strategics thinking about the art of the possible as they evaluate the M&A chessboard for segments and businesses. And increasingly, corporate separations, so-called spin-offs into mergers, are becoming a key part of the toolkit.
Dunbar also adds that spin-offs are helping CEOs simplify their message to Wall Street as investors look for more pure play opportunities. Upcoming deals that we know of, there's 3M, which is in the process of spinning off healthcare sometime later this year. GE's power business will go public in 2024. And then, Sarah, there's Kellogg with that spin-off expected, I believe, end of 2023. So a lot.
Three companies. Alibaba, too, gave an update today.
Exactly. With plans to push forward with that spin-off of their cloud business, a $12 billion spin-off there. So clearly, and CEO Daniel Zhang said here that the goal is to really simplify the structure. In fact, one of my favorite stats is if you look across the S&P 500, 2/3 of companies have 3 or more segments that are making $500 million or more, right? There's just all this unrealized value that a lot of people would say is really driving this spin-off trend.
It's going to be interesting to see what's the larger dynamic, sort of consolidation in certain industries, say media, or this, where you end up with more companies listed than fewer.
And perhaps to your point, it depends on what sector we're looking at. In some businesses, consolidation makes more sense. But when you look at the industrials and pharma and broader healthcare, where we've seen just years of M&A and growing out their inorganic pipeline, at some point, do they really shrink to grow? Do they try to find those opportunities to spin off? And does that create an opportunity for investors at home, especially with that data showing spin-offs on average perform better than the parent co?
We've talked about the conglomerate discount for a long time.
Okay.
People want pure plays, right?
Right.
I mean, it's hard to don't give me a basket, give me a pure play.
I mean, look at the explosion of pure play exchange traded funds, right? Not just an S&P energy sector, but give me wind, give me renewable, solar, real tangible ways to play those specific assets and subsectors.
Very cool.